Welcome to Capitalizing Your Life, the podcast that shows you how to take control of your money, build lasting wealth, and create financial freedom using the infinite banking concept. If you're ready to make your cash flow work for you instead of someone else, you're in the right place. Here's your host, Glenn Yaney.
What's up, everybody? Welcome to another episode of Cash Flow Conversations, where we interview entrepreneurs on cash flow strategies and how they created their wealth. And today I'm pretty excited. Sometimes you meet people who just get it, okay? This guy grew up in real estate, has a number of multifamily units, and understands the idea of debt and cash flow, assets, taxation, all of that stuff. So super excited to interview Glenn Yaney. Glenn, it's good to have you here, buddy.
Thanks for having me. I've been a long-time listener and just excited to be on.
Yeah, buddy. Thank you. Yeah, when we met, you reached out and said you've listened to all of the podcasts. I was like, well, that's phenomenal. Somebody is listening. So good for you.
Yeah, definitely have a little bit of obsessiveness to me. So
I noticed that, but you're also obsessed with the research mode, which I think is great.
Yes.
And what allowed you to do that is setting up a lifestyle that you're not a slave to.
Giving yourself bandwidth helps a lot. Yeah, definitely.
So a lot of the people I interview, we talk about, where they came from. And, to be an entrepreneur, usually you don't have your parents and your friends around you saying, hey, go take risk in yourself. You know that paycheck that you're getting every week? Ignore that and go start something on your own. So what got you involved in real estate in the first place?
So I don't know if you remember this, but as a kid, they had on TV, like late night, you could turn on a TV and watch like scrolling through photos on cable TV. Like that's all it was. It was like, here's the front of the house. Here's the kitchen. And that's and my mom, she worked in a bank. She would talk about loans and stuff like that and really just getting me educated in, just what business owners are doing. And then I watched that happen through my mom. And then I watched my family go through the turmoil of 2008 and watched how devastating it can be without a lack of capital, capital and cash flow, So that's really how I got tied into focusing on cash flow throughout my financial career.
And that allowed you to create a lifestyle that opened up your bandwidth to study and learn even more, which you've continued for decades. I'm just kidding, not decades, but for a long time. So
yes.
Walk me through your first real estate deal.
Yeah, so my first deal wasn't that great. All I worried about is that I could pay for it on my Red Lobster income. After I had already left Red Lobster, I thought I was going to always have this fear in my mind that if I ever have to go back to Red Lobster, I have to be able to pay this mortgage. And my mortgage was $565. I was nervous about signing the mortgage. Just to go back a little bit, I left Red Lobster to work for a REIT where I went from making $1,500 a month to $15,000 a month.
It's a good increase.
And always kind of kept my spending as if I were to go back to Red Lobster. And I was very motivated towards finances. I read Rich Dad, Poor Dad. I read Total Money Makeover. I got onto the Dave Ramsey train. In my opinion, the good thing about Dave Ramsey is he builds the saving muscle, So it's like Some people can't do it. I couldn't do it beforehand. I could never get ahead. And that savings muscle was created through figuring out how to pay off my Honda Civic 23.9 interest rate that I had on that Honda Civic. It's like
23 point. What'd you buy it with a credit card?
It felt like it, but I traded in my truck that was 1 month behind on its payments and nobody was willing to give me a loan. And the only one that was willing to give me a loan was, I don't even know. It was a no-name finance company at 23.9 interest rate.
That's predatory lending. But it's funny. One of the things I always talk about is in order to get a good interest rate on a loan, prove you don't need the money.
Exactly.
Because you needed the money and they got to charge whatever they wanted on the back end.
Yeah, but even that example, for me, I didn't care about the interest rate because I knew because my truck was a 0% interest rate and my car was a 23.9% interest rate, but my cash flow was increased by $200. And that's really why I did it. I just knew I wasn't going to have to spend as much on gas, insurance, and all these things. And that was the main driver. I was like, I can figure out the interest rate later. Let me just get this car to where I can be able to afford my life. I was working at Red Lobster. Yeah. And then what I started doing is learning how to pay myself first, put $50 in the savings account. And that was really the beginning for sure.
Did you have a girlfriend or a wife back then?
No, I was.
And so that was some risky there too. You traded a truck for a Honda Civic. So then you needed to find a girl that didn't care that you're driving a Honda Civic. Good for you.
I went a long time without a girlfriend.
I don't know why. Those Honda Civics are great cars.
Yeah.
So the good for you. So to your point, Dave Ramsey, you're right. The saving muscle stays with us forever. Dave does do a good job teaching people how to not spend more than you make. What a novel idea. And then you did what I teach in my book right away. The number one way to increase wealth is your income.
Yeah.
This is what you spend your day doing. How do you increase your income first? It's always easier to create an extra $10,000 of income in a year than to save an extra $10,000 on a fixed income.
100%.
So how do I increase my income? That's exactly what you did. You 10x your monthly income, and then you wanted to buy cash flowing assets. So talk to me about the real estate that you ended up getting into.
Yeah. So it was still a cash flow equation. And really, I was looking at my monthly expenses being $565 a month, and that my current rent at the time was $1,000. So I was figuring out how I lower my expenses and also increase really my savings rate is what I was focusing on. And the property, I moved into it for a short period of time, was able to secure decent financing. And then I was going to turn it into a rental. And then my parents, I actually let them move into it afterwards. And I was like, I'm not going to charge. I just figured it was my way of somewhat giving back for all the things they've done for me, and really just gave them the mortgage rate for rent, so it turned into, it wasn't a successful rental, but over time it was accumulating assets. That rental that I paid $50,000 for turned into $115,000, sold it, and then was able to turn that money over into probably a mobile home park later.
So business owner doing what's best for the right reason ended up working out in your favor. What a novel idea. So not all business owners are evil. Good for you.
Yeah, I totally looked through, there's certain cultures but I can see where when families work together, they are able to build a better financial structure for everybody.
Yeah. Yeah. And it paid off in the end.
It did.
There's
Yep.
multiple rates of return in real estate. There's equity. There's an exit in the future that theoretically is going to be higher than what you paid. There's cash flow. There's tax ramifications. So it's not just one rate of return when it comes to real estate. So you've turned the one into many. I think you're now in hundreds of different doors all over. Right?
About 600, yeah. So I found a mentor, and I always was seeking for mentors. So I had one mentor. He had about 20 units. He became a long-term business partner. We scaled up to 600 units together. I had another mentor that he had 600 units when I met him. Now he has 1,600 units, and I would take my days off on like a Tuesday because I'd work on the weekends, and I would go follow him around. And I could tell you that education that I got from him was, I don't even know if you could pay for it, but I would say that it would be hard to find. And I just watched him manage his parks and just learn like how he thought about things. And I could tell you the real quick story about those two guys, the guy with the 20 unit and the 600 unit. I was plowing 50,000. By this time I had my fiance, maybe girlfriend, wife. At the time, we were plowing as much as we could into our 401ks. She was going to work and putting 70% of her pay into her 401k. The HR person that talked to her said, you're not going to receive a paycheck. And she's like, I know, this is what my husband wants me to do.
Oh, no.
So yeah, I'm doing the HSAs, the IRAs, whatever, 401ks. I'm doing Roths, whatever it is. And literally it came out to $56,000 a year. And I would talk to these mentors of mine and tell them that this is what they should do. And they would just like nod their head. Yeah, that sounds like a good idea. Keep it up. That's what they would say. And then it kind of set me back. And it's like, this is why it's better to be a listener than to be like the person telling people what to do. Because when you're listening, you can kind of grasp the situation that you're in. It took me a little bit to understand, but I'm like, these guys, I would ask them how much money they had in the stock market and other investments outside of themselves. And they had zero invested outside of themselves. All of it was into real estate and maybe some other assets they were managing, flipping, or whatever they were doing. But that was one thing that I learned. And I thought to myself, if I'm saving $50,000 a year into this 401k or qualified retirement plans, I need to save. How do I buy more real estate after that? And I realized I'm never going to buy enough real estate if I don't have anything else, no liquidity. And I'm creating an illiquid scenario in my life. And that's when I started pivoting towards lines of credits and stopped funding my 401ks because I learned that I'm like, I could put 50,000 and then with lines of credits, I could actually extend that to be even more money that I could buy in real estate. And that's really what gave me the launching pad, is really understanding leverage and creating liquidity in my life.
You have a good story here too about when you realized the 401 and the traditional retirement account that we're all taught we're supposed to have wasn't the best thing for you. What did you end up doing?
I'm like a extreme person. So I ended up, what I could tell you is I went down to the match because they always tell you should keep the match. And then I thought that this 5% that I'm paying is just another drag on my financial independence, because I'm not going to be financially independent when I'm 65. I'm going to be financially independent when I'm 35, 40.
Yeah.
That's what my goal was at the time. I was like, I got like 5 to 10 years. And once I pivoted from putting my money into a 401k and focusing on liquidity and cash flow investments only, it turned into 2 years later, I'm leaving my W-2. I bought a 3-unit mobile home park. I bought a 9-unit mobile home park and really didn't need that much money to do it. But I think my thinking changed the opportunities. It's like when I hand my money off to Wall Street, I think that that's telling me that I'm not good enough to manage my own capital. And when I do that, it slows me down. It slows me down to growing where I want to go. And that's really what happened is I stopped giving my money to Wall Street, the qualified retirement plans, thinking that somebody else is going to take care of me, and realize that nobody's here to save me and that I need to figure it out. And that's how it started.
Dude, that's awesome. Thank goodness you had that epiphany so young too.
Yeah.
But then talk to me about the 401k. Where is it now?
So I started learning.
I'm baiting you here because I know the answer, but I'm baiting you on this one.
I started looking, getting into real estate. I mean, I left my $150,000 a year job for $1,500 a month income. Back to Red Lobster income is what I did, but the opportunity was way better. So I had $100,000 saved in my bank account, and I did have a little bit of income from my rental property. So I would say that my real income was around $5,000 a month, but the earned income was around $1,500. And I started it's almost like you have your back against the wall, but I have the $100,000 behind me. What I started doing is just trying to be creative. Like, how do I create more income? And then we found is cost seg studies. What ended up happening is I started draining I had $300,000 in my 401k and IRAs, and I just started slowly chipping away at them. I pulled $100,000 out during 2020 because of the CARES Act.
Yep.
And then the next year, we had an opportunity show up where it was a smaller mobile home park, but it was a good deal, good cash flow. And I thought, if I took $200,000 out, I'm going to make, we'll say $2,000 to $2,500 a month on this $200,000. When it's just sitting in my IRA, it might be earning, even if it was earning 10%, it's not doing any beneficial thing for me except for me able to open up my account and look at the growth. But really, when I have cash flow in my life, I'm able to have time freedom. I'm able to go out and to my kids' recitals in the middle of the day. These are things that you're not able to get back when you're 65. So what I did is I pulled out like $200,000 and then I kind of timed it between December and January. But what I did is I used cost seg studies. And because I'm a real estate professional, I was able to deduct 100% of my pay because I was able to buy that property because I had the liquidity. Hey guys, if you'd like to learn more about the infinite banking concept and how to flow your capital through your own financing system, my team and I are here to help. With over 35 years of experience, we can guide you in building a properly structured whole life policy tailored to you and your family. See the scheduling link below. Now, back to the show.
So you took out $200,000 out of a retirement account before the age of 59 and a half, utilized a cost seg study to get your income to zero. So you paid no tax on that distribution, but you still had to pay the penalty.
Yes.
So it cost 10% to get the capital. And what has that turned into ever since?
I mean, at the time, the way that we had the partnership structure, it was between 12 and 15% on the first year. So I said I would pay that freaking penalty back immediately. And why not? And I can tell you these promissory notes that I was writing are also the things that kind of kept me through the downturns of this previous market. There has been times where the preferred returns have stopped, which is not fun. And because of those preferred returns, promissory notes are structured more of like a loan. And those loans have kind of carried me through the past, couple years with liquidity events happening, or bad liquidity events so I'll tell you, just to go a little bit further, I set up my properly structured cash flow life insurance in 2024. And, we're always worried about okay, I'm writing a big check to fund this premium. And what happens if my income goes away or something like that. And that exactly is what happened.
Yeah.
My income, the preferred returns slowed down. And then also what ended up happening is 2 hurricanes. One flooded my house. And then the second one came 15 days later and flooded my properties, the 3 and the 9 unit that pay a lot of my bills.
Ouch.
So that was like 40, that was 125 grand that I had to come up with in the next 4 months.
Mm.
And for me, I believe that, structuring yourself towards liquidity and cash flow is the only reason why I was able to get through that storm, like legit storm, but also personal storm. Like it was my life felt like I was in a tailspin, it just, things were happening. But as a deal junkie, being a real estate operator, there's deals always that show up. Like you put deals under contract that you don't have money for, you figure out the numbers, the capital later. But when I start focusing on liquidity and cash flow, the liquidity is what gets me better financing through the banks, which gets me better cash flow. It's like all these things are happening and my cash flows increased through that whole process. After it took a dive, it's been like a rebuilding, but now my foundation's even stronger.
So you mentioned something in there called cash value life insurance. When did cash value life insurance enter your world? Because when people listen to this, we're talking real estate and taxes and all that, and then you just throw out life insurance. How does life insurance help a real estate investor?
In my opinion, it's the most powerful thing on my balance sheet. The banks don't care about really how much real estate you own. They might look at the equity, but they want to see liquidity. And I can tell you that I had 2 failed refinances that happened right before 2024. It was about 18 months of underwriting, trying to figure out the right way to go about this refinance. It was like 6 or 7 partnerships that we're trying to figure out if we should combine them or sell some properties. And it was a mess. And then my balance sheet personally didn't look that strong because I'm constantly buying more real estate. So instead of focusing on liquidity, which would have made it easier for the banks to say yes, they're seeing this guy that doesn't have any money in his bank account and all this real estate. So they're like, this guy is just like one mistake away from from losing it all.
Yeah.
And the one fear that I've always had, I don't have the fear today, but I would say that I never want to be the guy that says they had 600 units and no longer don't. I no longer have 600 units. And that was the big fear. And I think that with this balance sheet item that I've created for myself, it instills that I'm able to survive the next turn. We have these downturns. We have income cut in half. We have all these things that happen. 2 hurricanes hit you back to back. It's like, but the cash value life insurance is the only consistent, guaranteed thing that stays consistent and the certainty in my life.
Amen.
That I'm able to take advantage of opportunities while these things are happening to me in the middle of all of it.
And so when you say this, I want to be clear for everybody listening. We're not talking about indexed universal life. I'm not talking about variable life insurance.
No.
Those products carry market risk. As much as your advisor is telling you that there's a floor of 0 in an IUL, it can't go down. There's still cost of insurance coming out and fees and all sorts of charges that are kind of hidden in the contract. So in the year that the market doesn't do well, you might have a floor of 0, but your cash value can go down in that contract. Whereas whole life, which is what you're talking about, does not go down. It can't go down. It's guaranteed by the insurance companies, which are hundreds of years old. So you are fixing, what I love the way you phrase this, as a true real estate professional, you're fixing a balance sheet item.
Yep.
You're showing liquidity that's guaranteed to be there. Banks love it.
Yes.
And if you want proof that banks love it, look at the bank's balance sheet. Bank of America, $22 billion in cash value. Wells Fargo, $25 billion in cash value life insurance. They're not doing it for the death benefit. They're doing it for the liquidity and the tax benefits. And by the way, it has a death benefit.
Yeah, it's back to the IUL thing. The problem with IUL is there's lots of uncertainties. And with whole life, properly structured whole life, we're creating certainties in your life. And that's really like, we have enough. And for me, I take enough risk outside of where I hold my capital. So I want that capital place to be as secured as possible. And that's really why I love the whole structure balance sheet.
The capital inside of your whole life is off the radar of the IRS for income tax purposes.
Yep.
In Florida, it's off the radar of creditors. So if you get sued, they can't touch it. And banks can use it as collateral. What a glorious place to store capital and then deploy it when everybody else doesn't have any money. So in 2008, when you saw the markets crash around your family, a lot of people lost a lot of different properties. And the people who had cash in 2009, 10, 11, 12, 13, 14, The people who had access to cash have made a fortune since then because real estate has done nothing but go, well, the last few years has been sketchy, but from 2008 to 2020, the market just went up. And so people who had access to the capital crushed it.
It's really like the thing with the 401k. I'm like a big advocate of talking about it, but the 401ks, when you're withdrawing from a 401k, there's two ways. You can take a loan or you can withdraw it and pay a taxable event. The taxable event, guess what? If you're pulling from your 401k, you don't have the money. So the taxable event is going to hit you later and you're going to not have the money unless you have some thing that you're going to be doing. But it's like,
you pay right out of the distribution, which means you're just taking less to work with.
So you could do that, but I would say that at the time you need the money. So why would you do that?
Exactly.
So it turns into, I mean, I'm not giving advice, but I'm just telling you that's the reality. You're like, I need $100,000. I have $100,000 in my 401k. I'm going to pull it out right now, and then I'll pay for the $40,000 later. And what happens? The 40 grand's not there, and then you're freaking on the hook, and you can't even. I don't even know if. Yeah, then you have to fight with the courts to file bankruptcy and all those other things that come up. It's just a terrible way. But go ahead.
Well, I want to say one more thing because you mentioned loaning from a 401.
That's what I was just about to talk about.
Okay, yeah, go ahead.
So I've looked into all this. I've done it. I've done self-directed IRAs. It's the gateway drug to pull in your 401k for me. And that's how I started is I put it in a self-directed IRA and then I yanked it right afterwards. That's how I started. The thing about the loans is the repayment structure is terrible. It's like, do you want to just go get a car loan? That's what a repayment structure on a 401k is. And I think the worst loan you could possibly get is one of the worst is a car loan. The car loans are just structured terribly. You borrow $30,000, you have to pay $600 a month back. Show me an investment where you can put $30,000 in and you get $600 monthly payback. That's a great investment for the person that's lending it. But for the borrower, it's a terrible deal.
Yeah.
What investment are you going to put $30,000 in and then have $600 cash flow?
Yeah. And what's the reason people put money into a 401 in the first place? Well, you hope you're going to get to this thing called retirement. So who knows how long that is. But the reason people use those plans is because the CPAs are lying to us saying it's a tax savings. There's no tax savings. You never got the money. That's why you never pay tax. It's not yours. And so if you borrow from the 401, the people will say, well, you're paying yourself interest. Okay, after tax. If the benefit of a 401 is to get tax-free, when I take money out, when I pay it back, I'm using after-tax dollars to pay it back plus interest, and I'm going to pay tax on all of it on the exit. Again, that's a double tax. Now I'm paying taxes twice. I'm defeating the supposed purpose of having the 401 in the first place. When a real estate investor talks about fixing their balance sheet, it's funny, when you went to get a loan for these real estate deals, how often did they look at your 401 as collateral?
I mean, they do look at it, but what are you going to do? Are you going to pull on it? I mean, the reason why banks underwrite you is to make sure their investment's safe. And if they're not giving you money, you got to think to yourself, what's the reason? And this is something an investor told me. He said, the reason why the banks won't lend you 90% on an investment property is because they want to make sure that their collateral is safe. And if you're trying to get to 90%, which we have in the past, the question is, how safe is this investment? So it's just one of those things where you have to be able to think like a banker and know that we're not doing this to be a flash in the pan. We want to have 600 units to have 1,200 units later. I don't want to have 600 units to talk about that I had 600 units later,
Right. And we got to end this fairly soon. We're going to do another one of these because there's so much more to talk about because the way you structured your balance sheet using whole life insurance has accelerated your ability to get more properties. Is that fair?
100%.
Because the banks recognize it. And banks don't lend against 401ks because if they do require the collateral, they know that you're going to pay penalty and taxation. So if you show $500,000 in that 401, that ain't yours. If you want proof, take it out. You'll never get the $500,000. Your CPA will be the first to tell you, you owe tax and penalty. And the banks know this. They're not leading with this, but they know that $500,000 is a fake number.
It's like, do you want to partner with somebody that decides how much they get at the end of the deal? That's how it was explained to me. I was like, no, I don't. Yeah. Why would I want to do that?
And then just while we're on it, you can do brokerage accounts. You can get lines of credits on brokerage accounts. That's also a quick way to zero. If a lender will lend on a brokerage account, they're not going to lend up to 96% of that account. To your purpose, they want to protect their principal.
Yep.
So they're going to loan 50, maybe 70% on the brokerage. The problem is that the underlying asset, the brokerage account, can still lose value. And if it goes down drastically, the lender can call the loan. Now you're forced to sell and you're left with nothing. So the reason that whole life is so good for real estate, it's guaranteed to be there. It's guaranteed not to go down. So there is no volatility in the underlying collateral. And by the way, the IRS doesn't tax any of the growth.
I mean, with everything we do outside of our long-term retirement planning or whatever it's really, which I don't believe in retirement, so it hurts me to say it. But anyways, this place where we store our safe capital, we want as much certainty as we possibly can get to be able to take advantage of opportunities when we can. And that's really how you buy the good deals. You buy the good deals by having capital when no one else does. You have confidence to move forward. When you have that confidence, the seller is going to feel the confidence and know that you're the person. So they're more likely to sell it to you than some guy that will pay a little bit more, but they don't know if that person's going to close. So I know we're running out of time, but
no, this is great.
The certainty that you add in your life with a strong asset like that.
100%, dude. We're going to have a lot to talk about. So if you're listening, make sure you hit that subscribe button because we will have Glenn on again, probably next week. And we're going to review more on how to fix your balance sheet using guaranteed overfunded whole life insurance off the radar screen of the IRS for income tax purposes. Got to say that for compliance. And off the radar screen of creditors, depending on where you live. So Glenn, thank you so much for being here, bro.
Thanks for having me.
All right. See you guys soon.
Thank you for listening to the Capitalizing Your Life podcast. Please rate, like, subscribe, leave a comment, and share with someone who you think would enjoy listening.